Hi, I'm Karen Erickson, and this is my daughter Kayla Caruana. We are both certified financial planners, and we run a practice at IG Private Wealth Management.
Today we're going to talk about taxation.
Ooh boy, very fun. Yes.
Super fun.
Yes.
So what we do as certified financial planners, which is a bit different than what accountants do, is we try and decide on the tax things that are going to happen in the future. So anything that hasn't happened yet and we're deciding on, that's where we come in.
Yeah, creating a strategy, making sure that it's good going forward.
Our accountants and at head office, as well as our clients' accountants, they work on the tax implications that have already happened. And that's why we want to work closely as a team to have a holistic view on a client's financial plan so that everyone's working together cohesively. We have accountants as clients, and this strategy works really, really well for us.
So nobody wants to pay tax. The government isn't going to send you flowers or wine or chocolates when you pay more than your fair share of taxes. So when you're working, we really want to look at your marginal tax bracket each and every year to make sure that you're making the right contributions, maybe to an RSP, to reduce the amount of tax owing each year. But then when you are retired, you might have a big RIF or an RSP that we need to deconstruct over time. So everybody's tax brackets are different. It's not applicable to all, but one good strategy to consider if you are in a lower marginal tax bracket is to actually deregister some of your RIF money a little earlier than you anticipated to get things out in a tax efficient manner over time.
And when we construct these financial plans that help incorporate the deregistration, we're taking into consideration the tax brackets and also taking into consideration how much income that you'd like in your retirement. So those types of tax plans require proactivity, and that's where the financial planner comes into place. The financial planner is the person who's going to make that tax plan and also figure out execution-wise how we're going to build it out.
So when you're retired and we're building out an income plan, you have to consider the taxation of each investment. So if you have pensions from work, CPP, old age security, that's full taxable income. Then you move into more tax-preferred investments like dividends and capital gains. And then the ultimate, of course, is the tax-free investments, which are tax-free savings accounts and your principal residence. All are equally important to take into consideration.
What we get often asked is, how can I tax efficiently take all of this money out? I've got my nest egg, now what am I doing to get it out? That's where we come in when building the tax plan to create that income. It's very easy for you to figure out where to put investments. You can use the internet to find all sorts of things on how to invest and figure out where to put the investments. It's a lot more difficult to figure out how to take those investments out in the most tax efficient way possible. One of the most common improvements that we can make in a financial situation is assessing whether or not the correct investments are in the right investment vehicle. The investment vehicles being the registered accounts, the non-registered accounts. Do we have the correct type of investment in that account in terms of taxation?
For registered accounts, it can be a good strategy to have your 100% taxable investments inside of those, because when you pull money out of an RSP or out of a RIF, it is fully taxable anyway. Where you'd want to have more tax efficiency is in your non-registered, and maybe where you might want to chase more growth is in your tax-free savings, since all the growth that you earn is all tax-free. Has your advisor ever asked you, what is your philosophy about tax? That might seem like a really weird question, but it's a really super important one.
When we talk about taxation and building out your plan, we want to assess whether or not you'd like to pay more tax while you're alive, or would you like to delay some of those tax implications until after you pass away and pay more tax after death. It's important to consider your lifestyle, whether or not you have kids, whether or not you'd like to equalize your estate for your beneficiaries. If you haven't watched our video on estate planning, you can absolutely go find that video. We talk in depth about what the estate plan and the tax plan looks like after death. Just to briefly touch on the estate tax side of things, when we talk about the investments and the vehicles of investments, we need to understand how they're also taxed upon death. One of the The big tax that we talk about is the income tax side of things. When you pass away, your RIF and LIF and all of the registered accounts besides the tax-free savings accounts become 100% taxable as income. You can imagine if you're the last person standing and you pass away and you have a $500,000 RSP as an example, how much income tax that will generate. Those are the types of conversations we want to have to ensure that we're dealing with whether or not you want to deregister some of that now, slowly over time while you're alive, or if you'd like to have that tax bill upon the last person's death.
As a certified financial planner, we're making sure that your tax is always being checked. So we review our clients' tax returns to make sure that you're optimizing any deductions and credits. It's important to understand the difference between a tax credit and a tax deduction. And you want to make sure that you're also deducting your advisory fees on your tax returns each year. So making sure somebody's having a second look once your taxes are done and filed.
So once we feel like we've got a really good handle on the 101 and we've dealt with all of the basic tax implications, we move on to the more complex strategies for the high net worth. And those strategies are more like a 201.
So some of those more complex things that we could do is a spousal RSP for when you're working if both of the incomes are not the same. So one spouse has a high income and one spouse has a lower income. And then even more complex is more of a spousal loan and income splitting during retirement. So there are some strategies that we can minimize taxes and split taxes across a couple.
So you might think, I'm not sure which strategy is applicable to me. We can absolutely help with those situations, especially when we're taking into consideration during your lifetime, one person's making more than the other. When we're putting into place these strategies, we also want to figure out on the other end, when we go to take the money out, do we have equal pots of money? How is that money going to look when it comes out? You'll want to take all of those things into consideration and think of the end goal versus what you're doing just right now.
So once you're well into your retirement, you might have an instance where you sell a rental property or you sell your principal residence or you have non-registered accounts that you now need to turn into tax-efficient income. We have a T-Series investment that actually will do just that will send you stable, tax-efficient income stream throughout your lifetime, and it will help you to make sure that your whole tax plan is tax-efficient.
To keep it at a high level, the T-Series investment has some return of capital, interest, and dividends. It's a mixture depending on your risk tolerance and as well as your timeline. We will adjust that accordingly. What's important to remember is that something like this will help to lower your overall tax bill, and some people call it magic because it's a bit of a different strategy that we're able to have implemented into your plan if that's what you require in terms of tax efficiency.
So today we've covered one of the drier parts of financial planning.
You could say it was taxing.
Yes, but it is important. If you would like to find out more information on your tax plan and your financial plan, please reach out to us. Thank you so much for watching today.